pretty sure that I covered everything, almost everything that's going to be in the slideshow. I did notice that I missed listed property, so we'll come back to that. And then Form 4562 is the form that you have to file anytime you put something new into service. It doesn't have to be new, it just has to be new to your business.
And what form is that?
4562. And you also have to use Form 4562 if you have any listed property that you're depreciating.
So ultimately the IRS gets notified of all of your 100 purchases that get depreciated?
Yeah.
Unless it gets expensed.
Right, yeah. And then the 4562 only lists categories. So you might say, I put $125,000 worth of 7-year property into service. And it doesn't itemize it out.
Now, do you have to do that when you buy the property and it goes into service, or at the end when you do your taxes?
No, it's attached to your tax return.
Okay, so I don't have to go and get the 4562 and fill it out until it's tax time.
Right. It's just attached to your tax return.
I thought at one point you said for vehicles and other stuff you need to have like VIN numbers or something like that, or not?
No.
Is that part of the mileage?
You'll need the mileage. You'll need a mileage log for your vehicles.
Okay, and those ones have to have like VIN numbers or something. Or I guess for some reason I always thought that you had to list individual pieces of equipment.
For listed property, you do, but it doesn't have to be by VIN number, although that's one way to do it. I did, for a while, do tax returns for a fairly large trucking company with between $5 and $10 million in revenue per year, and their fleet was, it listed by VIN number.
So someone could basically choose to not have as much detail if they don't want to go through all that, and from a tax return standpoint, and just rely on the company report.
Yeah, most of our listed property or vehicles will just say 2022 Dodge Ram 2500. That's all it says, or Ford F-250.
Okay. So whoever's making the report or that list probably knows what it is, but beyond that, someone's not going to be able to specify that this is not that vehicle, or like.
Right, and I would, if I needed more specificity, like maybe you bought 3 Dodge or Ford F-250s, I might just use the last 4 digits of your VIN number to make sure we knew which one was which, in case one of them broke down or was sold, or something like that, or is trashed. Okay. So, depreciation deduction is, this is wrong, and it's not a reflection of the decrease in value of the asset. It is a method of allocating the cost of an asset over the multiple years that it's in use. And then we'll need to know things like your depreciable basis, which is usually your cost, including expenses of purchase and putting it into its intended use. Useful life is your recovery period. We have this double declining balance is the standard way of taking depreciation deductions. And what that means is, let me real quick give an example.
Is it heavy on the front end?
Heavy on the front end. So I'm just going to give an example. You won't ever have to do this yourself because you'll just be looking these up in a chart on publication 946. That's the publication number. But for example, if I have, to make the math easy, let's say I bought some equipment for $14,000, 7-year, using the half-year convention. What double declining balance means is, instead of dividing by 7, which would be what you would do for a straight line, I'm going to double it and divide the result by 7. That's what double declining balance means. So 28,000 divided by 7 gives me 4,000 per year at the beginning, but I'm going to get half a year. So year 1, gives me a $2,000 deduction. And so that means I have 12,000 left over. Double that and divide by 7. 24,000 divided by 7 is divided by 7 was, let me double check the math.
4,000.
4,000 half year, okay. So that leaves me 12,000 times 2 divided by 7. That gives me a year 2 deduction of, it turns out to be $3,429. And it's going to leave me for year 3, what's left is $8,571.
So you're doubling the starting balance of the year
Yeah,
times 2 dividing by the standard schedule of 7,
yeah,
and you just keep doing that to the end until you run out.
yeah, but it's double declining balance switching over to straight line. So 8,571 divided by, or multiplied by 2, divided by 7, and that gives me 2,449 in the next year. For 6,122 still to depreciate. And this is where I'm going to, I've taken 2.5 years, I'll probably do this one more time.
Do I tell you it's the halfway point or just past the halfway point or something?
Until we're taking straight line for the remaining period is worth more. Is 4,373. This is where I'm going to make my test. So 3.5 years gone, 3.5 years left. So if I were to take this in even proportions for the last 3.5 years, this would give me a 1,249 per year. Or if I did it the other way, 4,373 times 2 divided by 7, 1,249. Does actually turn out to be the same. So that means year 5, 6, 7, it's going to be 1,249. And hopefully if I've done this right, oh, the last year, this is year 8, because I've taken 1, 2, 3, 4, 5, 6 full years plus a half year. So I get another final half year in year 8. Oops. Which leaves me another $624.
You don't round it up to 625.
No, and we'll see why in just a second. Because
First one of them was rounded or something.
plus. Okay, I guess I will round it up today. Total is 13,998, which is, it's off by $1 or $2.
So what happens with those $2 that are left over? You just add them to the last year?
Yeah. the charts are actually gonna have different percentages. So if we do this by hand, I would actually take this 1249 from the 4373 and divide that by 2.5. So one or two of these is actually going to be 1250 instead of 1249. But I just copied this down. So, but you do end up deducting. So it'll probably be 1250 here, and probably 1250 here, to make it a total of 14,000. So over the long view, I do deduct the full value of what I bought, that 14,000. But I deducted a lot more early on. In the first 2 years, I've deducted already a third of, the first year and a half, I've already deducted a third of the value of that vehicle, or that equipment. So that's basically what double declining balance is. And you saw what I did. I was doubling the remaining balance. This is the declining balance, and doubling that and multiplying it by dividing it by the depreciation, the recovery period.
Would most people go through all this for each and every piece of equipment, or would they only do this when there was a specific tax benefit that year to elect them to do something like this?
You would do this with every piece of equipment, but you wouldn't actually do any of the work that I just did, because if you look at publication 946, or I believe if you look in your book as well, hopefully it's in the book.
Yes, 23, 24, and 25 pages.
On page 15.
Yeah.
Page 15, it gives you these percentages, and it tells you what to deduct. So all the work is already done for you. So instead of redoing this work like I just did.
You're just referencing the percentage to take for that year
Right,
of the total starting.
right, of your total starting depreciable basis. So instead of doing all that work, I could have just said 14,000 times 0.1429, and that's my first year deduction. 2,000, well, there's where my extra dollar comes in. And then 14,000 times 0.2449, and I would get a $3,429 deduction, and so on. So, and then, so you wouldn't need to keep track, you don't actually need to keep track of this declining balance. This is just how the IRS produced these charts, is using that method.
And someone has the choice on each piece of equipment whether to do the straight line, double declining, or the Mackers, which what is it?
Mackers is the general structure.
Okay.
So you actually can elect a slower method if you want. So instead of the double declining balance, there's two others. You can do straight line or 150% declining balance, and those are all in publication 946. We get like the full charts.
And you do that individually per each equipment you select the method, or are you following a particular method for all of your equipment?
No, it would be per piece of equipment. So here at the beginning of Appendix A of Publication 946, let me clean this up before. Publication 946, Appendix A, is where we have our choices. So if we had 7-year property, we could do our half-year convention with any of our 3, 5, 7, or 10-year property class, and that's table A1. But we could elect slower depreciation methods. So we could elect instead 150% declining balance, in which case we would use table A14, or we could elect straight line, in which case we would use table A8.
So based on the class, you're able to I guess I'm trying to understand, looking at this chart. So you reference the class, and from there you see the options that you have?
Well, this table, this Appendix A, or the beginning of Appendix A, basically tells you where to find the chart you're looking for, and you're always allowed to use a slower depreciation method than what you're entitled to. So normally 3, 5, 7, and 10, you would go, the default is 200% or double declining balance.
Okay.
But you can elect instead, and it says this is where to find this table, you can elect instead 150% or anything for straight line.
The straight line is essentially the slower default to anything else. Okay.
And real estate, residential rental and non-residential are always going to be, remember, mid-month with straight line. So it's not going to appear in here because these are 3 through 25. Oh, here we go.
How about the instance of someone like, they have to replace a fridge in rental, right?
Mm-hmm.
And because a major component of it broke.
Mm-hmm.
And so is that considered, and so the maintenance guy goes out there and he's like, you know, it's gonna cost us as much to repair it as replace it or whatever. In any case, they choose to replace it.
Mm-hmm.
Is that in any way a repair or a general like expense at that point? Or does it depend on the cost?
Depends on the cost. If that replacement fridge is under $2,500, you can just deduct it.
Okay.
If it's more than $2,500, then you have to go through depreciation.
And so if you have like a triplex and it costs you $2,000 per unit for your appliance packages to replace them all or whatever, and you end up with like $6,000 total, is that going to depend if you have like 3 separate receipts or if it's all one receipt, or in a scenario like that, how would that make a difference? Or would it almost go per appliance? What are you looking at? I just can't help but wonder that for a lot of people, they have to depreciate it, but they don't know when they have to do it one way or the other.
So the regulations actually say if you don't have an applicable financial statement. Applicable financial statement means audited financials. You had a CPA go through and verify the information on your, which is at least cost you at least $2,000 for a CPA to do that. If you don't have an applicable financial statement, which is all of our clients basically, you can deduct up to $2,500 per invoice or item, which means that if you bought 3 appliance packages, and that includes washers, dryers, refrigerators, dishwashers. If each item is under $2,500, you can just deduct it.
So does it have to be per unit package? It can be the per item package.
Yeah, per item. So
Okay.
if each item is under $2,500, you can deduct it. If each invoice, you might have multiple invoices for a single item. If each invoice is under $2,500, you can also deduct it. Which is why I said when you bought the skid steer, you had 2 invoices, one for $2,000, one for $800 for the same item, you can deduct that. But if you have one invoice of $2,800 for the single item, then you're no longer in this category.
Okay. So in this case, if you bought what's like ultimately for a triplex, you got a dozen appliances.
Mm-hmm. If all the appliances each were under $2,500, then you can just deduct it all.
Almost regardless if you spent $20,000 to $30,000 total. If each one individually was under 2,500 and was line itemed in a way, or
Right.
shown on a receipt as a separate item.
Right.
Okay.
But you don't have to, you can, but you don't have to. And in that case, I would say it's probably better in the long run.
Unless they just want to pay less taxes that particular year for whatever reason.
Yeah. Because if you have a year of very low income and a year of very high income, you pay more taxes than if you have 2 years of median income. I lost my slide. Okay, and then we talked about conventions. Depreciation is tangible, amortization is intangible, and there's this other category called depletion, which really doesn't fit any of these rules, so it's just mentioned here. But it does, it's for land that has some mineral resources in it, because the land is worth less once you extract those resources. It kind of is the same concept, but is treated completely differently. So I'm just going to skim through these and make sure that I cover, or I haven't missed anything important. What can you depreciate? I did miss that you can only depreciate property that you own. So if you're leasing a vehicle, you can't take any depreciation deduction. Instead, count your expense, your lease expense, as a rental expense.
But then the company that you were leasing it from, they could use depreciation.
Yeah, they would. Yeah, the owners would depreciate it, and it must be used in business. So you can't just depreciate your television because you feel like it. It must have a useful, determinable life, which means that someday it's going to be obsolete and is going to end up going in the trash.
Like a rotary phone?
Yeah. Mm-hmm.
To a rotary phone?
Yeah. And it is expected to last more than 1 year. So because of this determinable useful life, land is never depreciated. So anytime you have real estate, like either like a warehouse that you own for your business or a rental property that you're renting out, you have to segregate the cost basis of the land from the basis of the building before you can take any depreciation deduction on the building itself. And that's usually done by looking up on myproperty.matsu.gov what the land and the building values are according to the property assessor, and using that same ratio for what you actually paid for the building.
So something like that in my property, so you might buy it in, say year 2010, but it's now 2023. That land versus building ratio is going to change over time.
You would use the same year, the same year that you bought the property, or as close to it as possible.
So even if it might show 50% more value now, you simply go with whatever that year of purchase was.
Right.
Okay. And what you're doing then is just separating your basis into land and building at that time.
Yeah. So let's say, for example, let's say somebody bought my house for $300,000, and then immediately started renting it in 2023. So $300,000, let me jot that down, is the basis, but that includes the building and the land. So let's find out what the property assessment actually is. And according to the assessor, 40 out of $309,000 that they think that my home is worth, $43,000 is the land, and $266,200 is the building. So let me pull up my calculator here.
But that number puts you over 300, so do 300 minus the land in this case, right?
No, I would go 43,000 divided by the total appraised value, 309,200, which gives me a percentage, and multiply that by the actual purchase price, and that would say 41,721 is land.
So that somehow takes into account the value versus the purchase price?
Yeah, because it's going to be the same ratios based on the appraisal. So that's going to be 259,000, 279,000 for the building.
Okay, and that 259, you then use that value and you
Yeah.
do straight line it from
Yeah,
there.
this would be what, so if hypothetically instead they bought it for 400,000.
So ultimately, it's taking, if you got a house on clearance or a fire sale or discounts of some sort, it's equally distributing that discount to the land and the building.
Yeah, exactly. So yeah, if they bought it instead for 400,000, 400,000 times that same ratio.
Then it would attribute more value to the land.
Yeah.
Certainly.
And so I'd end up with 55,627 for the land. I'll just round that up to 56,000 for the land, and that would end up being 324,000 for the building. So it'd be this is in the same proportion.
Okay, so you referenced the assessor for the proportion, but not necessarily for the value itself.
Right.
Okay.
Things you cannot depreciate is land is not depreciable. Inventory, that is your stock and trade, the stuff that you're buying for the main purpose of selling it to your customers, that's inventory, that's not depreciated. Anything that you placed in service and took out of service in the same year is not depreciated. And then most leased property is not depreciated if you don't own it. There is an exception because of how financial standards work, is if it's a lease to own kind of agreement where you have like a final payment and then you own the property, that's treated for tax purposes and for accounting purposes the same as if it were like just a mortgage. So if you're leasing some real estate and you're paying like $20,000 a year, and they say, well, if you make your payments on time for 30 years, you can buy it for $1. That would be treated as equally as a mortgage.
Can someone use the lease to own scenario with the 2-year rule for capital gains on a property that they lived in? Or
Yeah.
do they have to fully own it for 2 years after which point of lease
No.
it down?
No, they could use that.
So they can essentially almost pay like rent on it for 2 years, and some portion of that they can basically expense as like, I don't know, I'm just thinking they could basically lease to own it, and then after 2 years or 2.5 or 3 years they decide to sell it, and they have the
Well,
option
they wouldn't, well, if they had like a discount option to buy at that point,
the discount option.
like it would have to be somewhere in the contract that they could buy it early. Because the contract would say something like, if you make your, I mean, it would normally be shorter time, but if you make your payments you make 360 rent payments on time, you can buy the house for $1. It's gonna have to have somewhere else in there where you can buy it earlier than 30 years.
After 15 years or something.
I just don't know if that happens where someone basically gets into it, they more or less pay almost like rent on it, and while it appreciates in a, say, 5-year timeline, they are able to resell it without fully owning it on their own, and then like at that time buying it, like paying off the actual owner and the new owner, like all in that same title transaction.
Yeah, well, they could, I mean, they could probably pay the remainder of the lease payments. So if I was paying $20,000 a year for 30 years, my lease, I could probably say, well, you know, it's only been 10 years, but I'm going to give you the rest of the $200,000 that I owe you for the rest of the lease, or $400,000. So I'm going to give you another $400,000 so that I own the property so that I can sell it. And yeah, you could probably get away with that.
All at the same time as selling it?
Yeah.
Without having to fully pay out one party versus before selling it to the other?
Right.
Interesting.
Because it's called a capital lease instead of an operating lease, and the capital lease is treated as a financing type of arrangement. If you make any improvements to property, so you basically anything that adds to the useful life of the property, or adds to the value of the useful property, or changes its useful nature, like adapts it to a new purpose, that would be considered an improvement. Again, if it's under $2,500, you can just ignore this whole depreciation thing and just write it off. But if it's more than $2,500 per item or invoice, then that improvement is considered its own separate depreciable asset. So if you have a work truck and you put in a brand new engine into it, maybe increase the horsepower, something like that, that would be an improvement. It increases the value and it increases its useful life. That would be a separate depreciable asset besides just the truck itself.
What if it wasn't, what if the motor blew up and you had to replace it? Same thing?
Same thing, yeah, if it was more than $2,500.
What if someone was basically building themselves like a small accessory shop, and they spend 10 grand on excavation and preparation of the site, and then they pay someone $2,500 to pour them a slab, and then they pay someone $2,500 to like build them the frame, and then separately $2,500 for someone to like put up the trusses, and $2,500 for the garage doors and stuff like that. Ultimately, if they only end up having 50% of the cost of the overall building being above $2,500 transactions, could they then only have to put 50% of it into depreciation? Or
I don't think that's going to work. I mean, you could try it, but I think you would get audited and the IRS would throw that out.
Okay.
So I don't think that that revenue ruling or treasury regulation applies in that case, because it's all building a house.
Okay.
But if it was like, if you had roof repairs, there's a gray line between your roof being new or fixes being made to your old roof. There's a kind of a gradient there. Like, did we actually take your roof off and put a new roof on? That's pretty obviously an improvement and a separate depreciable asset. But if we took like a quarter of your roof off, is a quarter of a roof a thing that can be considered separately from the rest of the house? Like the roof, the whole roof, yes, but a quarter of the roof, or like 10 square feet out of the roof, where's the cutoff? And the cutoff is $2,500.
So if you decide you have a rental property, and you decide to expand the deck or to add a deck where one didn't exist, and it was $2,400, you have full choice whether to just expense it that year.
Yeah, you could just expense that.
Okay.
Keep it under $24.99.
But not too many $24.99s, because that might look funny.
that's about timing, when it begins and ends, we talked about all that. MACRS, depreciation. There's also this alternative depreciation system, so you can actually elect a longer lifetime if you really want to slow down your depreciation. So like some of our 5-year property, and I don't think any of this is reproduced in the book itself. So you'll have to actually refer to publication 946 if you want more information. But as a quick example,
So pretty much all the alternatives are longer.
yes. Yeah, this is why it's called accelerated. But as a quick example, I do happen to know that residential rental property is depreciated over 27.5 years under the general depreciation system. Under the alternative depreciation system, it's depreciated over 40 years instead. And there are sometimes it's specifically required by law to use the alternative depreciation system, and that is for any income producing property that is not on US soil. So the reason I know that is that 40 years exists is because I do have a client who owns rental property in a foreign country, and so the rental expense includes depreciation, but it's much slower than it would be in the US.
So you said the US has their standard rules for timeline of rental property, but if it's outside the US, then you suddenly have the longer timeline.
Right.
That you have to depreciate it.
Mhm.
Okay.
But if for some reason you want to take smaller deductions, and there's many good reasons, as I mentioned, to take smaller deductions, you can choose to take the longer period. But whatever you choose in the first year, you're stuck with that for the rest of that depreciation recovery period.
For that, whatever you depreciate.
Yeah, for that specific item. Okay. If you bought the property, the basis is usually its cost plus freight and installation and associated charges. There is other ways to acquire the property, and we'll talk more about basis in chapter 14. But if you change an item of personal use property to business use, and in this case business includes rental. If you change an item, personal use property to business use, your depreciable basis is whichever is less, what your actual cost or the fair market value on the date that you converted it. So for real estate usually goes up in value, so that's not as much of a big deal. But if you're starting a tree service and you have a chainsaw that you own, that you've owned for many, many years, it's probably worth, for fair market value, less today than it was when you bought it.
For sure.
So then you would have to use the lesser of.
Even if I haven't used it, it's still worth
Right.
less.
So if you have a pickup truck that you had for years and you bought it for 20 grand and now it's worth 10, and now you're putting it into service of your business,
Right.
then you're putting it into service of the $10,000 value.
Right.
How does that work from, are you showing income of any sort from putting your personal property that's now into business?
No. No.
Okay.
And then your basis for computing gain or loss is going to be based on your original cost minus your basis. Well, for computing gain, for computing loss is going to be based on this new basis.
Okay.
So if you bought a pickup truck way back in 2012 for $20,000 and it's worth $8,000 today, and you started putting it into service today, you would depreciate it based on $8,000.
And still you divide over that longer timeline, even though you only expect it to last another 2 years or something.
Right. But then, and then if you ever end up selling it, your gain is going to be your original price, 20,000 minus your depreciation deductions for computing a gain. But if you want a deductible loss when you sell it, the loss is going to be based on your 8,000 minus your deductions, because that 12,000 is that original $12,000 worth of loss is personal loss and not deductible.
So if you put into service at $8,000,
Mm-hmm.
but then after a couple of years you sell it for 12, then you're showing a gain of 4.
You will have neither gain nor loss in that case.
Oh, really?
Yeah, because you'll have what they call a dual basis. Your basis for purposes of computing gain is 20,000 minus whatever depreciation deductions you took. Your basis for computing loss is 8,000 minus whatever depreciation deductions you took. So if you fall in between those two numbers, you'll have a situation where you have neither gain nor loss.
Okay, so if you put into your business items that have already halfway depreciated, generally you end up in a bit of a safe zone in case you do decide to sell it, because you've already lost the value on it personally, that you're not going to be triggering gains.
Right.
Okay.
Okay, and then if you have some item of property that you use for both personal and business use, then you have to compute a percentage using some reasonable method to determine how much you're going to depreciate each year. That could be based on miles, it could be based on hours of use, it could be based on square footage, or any other reasonable method. For vehicles, it has to be mileage.
So do a lot of businesses not even bother taking depreciation on their mixed-use vehicle? They just take the mileage deduction and just leave it at that?
No, I think it's actually more popular if they're buying vehicles to take the actual expenses. Okay, we talked about these property classes, so we'll skip this part. Residential, non-residential. I'm not sure I mentioned, residential rental property is 27.5 years, and it uses the mid-month convention. Non-residential real property uses 39 years, unless it was placed in service before 1993, which will still be depreciating, almost done, and it's 31.5 years. So let's say you have a rental property and you replace the roof and it costs you $20,000. You would have to place that $20,000 new roof into service, and you would only get a depreciation deduction over 27.5 years, which means basically you're deducting less than $1,000 per year for the next 27.5 years. Even though you spent 20,000. What this is telling us here is that you can do the math and figure out what the roof you threw away was worth, and deduct that. Which means what I would do is, in an actual situation, is I'd divide the cost of the new roof divided by the fair market value of the whole building, and multiply that by the current, or the original basis, and split that off into where this is the building, the roofless building and the roof, and then figure how much depreciation would have gone to each. So it's a little bit of work, but we can do that work to figure out. So instead of getting you stuck with, oh, you only get to deduct $1,000 a year, well, at least you still get to write off the $8,000 for the roof you tore off and disposed of. So it's not a total, you're not totally screwed out of it.
So it's these exceptions to the straight line method, effectively.
Well, no, it's not. It's considered a property, disposition.
Okay.
Same as if you had just like tore down the building and said, I'm sick of this building, I'm just gonna tear it down and throw it in the trash.
So the actual extra understanding of it is easy, that you can depreciate that section, but figuring out what that section's worth is kind of the hard part.
Yeah,
Okay.
yeah, so I would say like if it cost you $20,000 to replace your roof and your building on that date is worth $400,000, then I would say, well, that's 5%. So I would say, well, then reasonably 5% of the whole building is the roof, and so I would write off that part of what you were still depreciating before.
So if it's worth 400 and you bought it for 350, then you do 5% times the 350 original purchase price
Right.
as your bonus disposal depreciation of a sort?
Yeah.
Okay.
So 5% of the original 350, but also reduced by 5% of the depreciation you took since you bought it.
So if you bought it for 350 and your current basis in it might be 320 after all these several years of depreciating it, you take that 5% of 350, but that amount then subtracts from the current 320 to get you even lower in terms of your current basis.
So yeah, so if your adjusted basis after depreciation is, to make the math easy, 300,000, 5% of 300,000 would be 15,000. So I'd get you a $15,000 deduction for disposing of the old roof.
Oh, so you don't look at your original purchase price, you look at the most recent basis on
Yeah.
it. Okay.
Yeah, the adjusted basis, yeah.
Gotcha. So whatever you ended the last year with,
Mm-hmm.
in a way.
Yeah,
Okay.
except it's mid-month, so I actually have to do it up to the date.
Gotcha.
Conventions, we talked about mid-month, mid-quarter, and half-year. As a reminder, mid-month is for real estate, half-year is for everything else, unless you put more than 40% of your depreciable property in service in the last quarter. And then you're stuck with mid-quarter for everything for that year. That convention, I didn't mention, whatever convention you were using on that property also applies in the year of disposition. So if you sold your truck after depreciating it for 3 years, you still get a half-year depreciation in the final year, whether you sold it in January 1st or December 31st or any time in between. And if you're using a mid-quarter convention on that truck, then it's considered sold exactly in the middle of a quarter. So February 15th or May 15th or August 15th or November 15th.